What is bond? Recently, I received this question from my audiences that they want to understand more about bonds and how it works. So in today's video, this is about Bond 101, and this is about education sharing video. Remember to do homework to understand your investments very well before taking action. So let's move on. Before I begin this topic, be generous to just click a like button if you really like it. Subscribe to my channel if you want to get more information about personal finance and money matters. So let's begin. Hi, my name is Louis, your financial educator. What is a bond? To simplify, it means you lend money to companies, municipalities, states, and sovereign governments for fixed interest return. This is for better understanding. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. A bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. Owners of bonds are debt holders or creditors of the issuer. Bond details include the end date when the principal of the loan is due to be paid to the bond owner, and usually includes the terms for variable or fixed interest payments made by the borrower. Now let's understand who the borrowers are and why they need the funding. We call them the issuer of bonds. Issuer of bonds are governments at all levels, and corporations commonly use bonds in order to borrow money. Governments need to fund roads, schools, dams, or other infrastructure. The sudden expense of war may also demand the need to raise funds. Similarly, corporations will often borrow to grow their business or buy property and equipment to undertake profitable projects for research and development or to hire employees. The problem that large organizations run into is that they typically need far more money than the average bank can provide. Bonds provide a solution by allowing many individual investors to assume the role of the lender. Indeed, public debt markets let thousands of investors each lend a portion of the capital needed. Moreover, markets allow lenders to sell their bonds to other investors or to buy bonds from other individuals long after the original issuing organization raised capital. So how do bonds work? Bonds are commonly referred to as fixed income securities and are one of three asset classes individual investors are usually familiar with, along with stocks, equity, and cash equivalents. Many corporate and government bonds are publicly traded. Others are traded on the over-the-counter OTC or privately between the borrower and lender. When companies or other entities need to raise money to finance new projects, maintain ongoing operations, or refinance existing debts, they may issue bonds directly to investors. The borrower issues a bond that includes the terms of the loan, interest payments that will be made, and the time at which the loan funds must be paid back. The interest payment is part of the return that bondholders earn for loaning their funds to the issuer. The interest rate that determines the payment is called the coupon rate. The initial price of most bonds is typically set at par, usually $100 or $1,000 face value per individual bond. The actual market price of a bond depends on the number of factors: the credit quality of the issuer, the length of the time until expiration, and the coupon rate compared to the general interest rate environment at the time. The face value of the bond is what will be paid back to the borrower once the bond matures. Most bonds can be sold by the initial bondholder to other investors after they have been issued. In other words, a bond investor does not have to hold a bond all the way through its maturity date. It is also common for bonds to be repurchased by the borrower if interest rates decline or if the borrower's credit has improved, and it can reissue new bonds at a lower cost. Characteristics of bonds. Most bonds share some common basic characteristics, including face value is the money amount the bond will be worth at maturity. It is also the reference amount the bond issuer uses when calculating interest payments. For example, say an investor purchases a bond at a premium of $1,090 and another investor buys the same bond later when it is trading at a discount for $980. When the bond matures, both investors will receive $1,000 face value of the bond. The coupon rate is the rate of interest the bond issuer will pay on the face value of the bond, expressed as a percentage. For example, a 5% coupon rate means that bondholders will receive 5% multiplied by $1,000 face value equal to $50 every year. Coupon dates are the dates on which the bond issuer will make interest payments. Payments can be made in any interval, but the standard is semi-annual payments. The maturity date is the date on which the bond will mature, and the bond issuer will pay the bondholder the face value of the bond. The issue price is the price at which the bond issuer originally sells the bonds. Two features of a bond, credit quality and the time to maturity, are the principal determinants of a bond's coupon rate. If the issuer has a poor credit rating, the risk of default is greater, and these bonds pay more interest. Bonds that have a very long maturity date also usually pay a higher interest rate. This higher compensation is because the bondholder is more exposed to interest rate and inflation risk for an extended period. Credit ratings for a company and its bonds are generated by credit rating agencies like Standard & Poor's, Moody's and Fitch Ratings. The very highest quality bonds are called investment grade and include debt issued by the US government and very stable companies like many utilities. Bonds that are not considered investment grade but are not in default are called high yield or junk bonds. These bonds have a higher risk of default in the future, and investors demand a higher coupon payment to compensate them for that risk. Bonds and bond portfolios will rise or fall in value as interest rates change. Categories of bonds. There are three primary categories of bonds sold in the market. However, you may also see foreign bonds issued by corporations and governments on some platforms. Corporate bonds are issued by companies. Companies issue bonds rather than seek bank loans for debt financing in many cases because bond markets offer more favorable terms and lower interest rates. Municipal bonds are issued by states and municipalities. Some municipal bonds offer tax-free coupon income for investors. Government bonds such as those issued by US Treasury. Bonds issued by the Treasury with a year or less to maturity are called bills. Bonds issued with 1 to 10 years to maturity are called notes. And bonds issued with more than 10 years to maturity are called bonds. The entire category of bonds issued by government treasury is often collectively referred to as treasuries. Government bonds issued by national governments may be referred to as sovereign debt. Advantages and disadvantages of bonds. The advantages of bonds are receive income through the interest payments, hold the bond to maturity and get all your principal back. Profit if you resell the bond at a higher price. The risk is usually lower than stocks investment. The disadvantages of bonds are bonds pay out lower returns than stocks. Companies can default on your bonds and bond yields can fall. Overall, bond is a lower risk investment instrument than stock. It is usually more suitable for investors who have lower risk appetite. It will be better if you can invest into bond mutual funds that consists of many bonds in one portfolio. Even if one bond defaults, then there are still many other bonds in the portfolio that can generate profit and cash flow. That's it about today's sharing. Hope that you like this content. If you wish to get more of this content, then comment below and let me know what is the specific content you want to know more about. I will read every comment and get back to you. So thanks for watching. See you in the next video.